Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Today on the podcast, I'll be discussing why stocks remain so resilient. It's Monday, July 14th at 11:30 a.m. in New York. So let's get after it. Why has the equity market been resilient in the face of new tariff announcements? Well, first, the import cost exposure for S&P 500 industries is more limited given the deferrals and exemptions still in place like the USMCA compliant imports from Mexico. Second, the higher tariff rates recently announced on several trading partners are generally not perceived to be the final rates as negotiations progress. I continue to believe these tariffs will ultimately end up just looking like a 10% consumption tax on imports that generates significant revenue for the Treasury. And finally, many companies pre-stocked inventory before the tariffs were levied, and so the higher-priced goods have not yet flowed through the cost of goods sold. Furthermore, with the market's tariff concerns having peaked in early April, the market is looking forward and focused on the data it can measure. On that score, the dramatic V-shaped rebound in earnings revision breadth for the S&P 500 has been a fundamental tailwind that justifies the equity rally since April in the face of continued trade and macro uncertainty. This gauge is one of our favorites for predicting equity prices, and it troughed at negative 25% in mid-April and is now positive 3%. The sectors with the most positive earnings revisions breadth relative to the S&P 500 are financials, industrials, and software. Three sectors we continue to recommend due to this dynamic. The other more recent developments helping to support equities is the passage of the One Big Beautiful Bill. While this bill does not provide incremental fiscal spending to support the economy or lower statutory tax rates, it does lower the cash earnings tax rate for companies that spend heavily on both R&D and capital goods. Our global tax team believes we could see cash tax rates fall from 20% today back toward the 13% level that existed before some of these benefits in the Tax Cuts and Jobs Act that expired in 2022. This benefit is also likely to jumpstart what has been an anemic capital spending cycle for corporate America, which could drive both higher GDP and revenue growth for the companies that provide the type of equipment that falls under this category of spending. Meanwhile, the foreign-derived intangible income is a tax incentive that benefits U.S. companies earning income from foreign markets. It was designed to encourage companies to keep their intellectual property in the U.S. rather than moving it to countries with lower tax rates. This deduction was scheduled to decrease in 2026, which would have raised the effective tax rate by approximately 3%. That risk has been eliminated in the Big Beautiful Bill. Finally, the digital service tax imposed on online companies that operate overseas may be reduced. Late last month, Canada announced that it would rescind its digital service tax on the U.S. in anticipation of a mutually beneficial comprehensive trade agreement with the U.S. This would be a major windfall for online companies, and some see the potential for more countries, particularly in Europe, to follow Canada's lead as trade negotiations with the U.S. continue. Bottom line, while uncertainty around tariffs remains high, there are many other positive drivers for earnings growth over the next year that could more than offset any headwinds from these policies. This suggests the recent rally in stocks is justified and that investors may not be as complacent as some are fearing. Thanks for tuning in. I hope you found it informative and useful. Let us know what you think by leaving us a review. If you find Thoughts on the Market worthwhile, tell a friend or colleague to try it out.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.